Good morning and welcome to our second day of coverage for Chapter 15. Today we will be finishing up Chapter 15. In just a minute, we will be looking at Exercise 7 from the Chapter 15 exercises. So if you have not already opened that, you should take this time to get into C now and open the Chapter 15 exercises so that you're ready when we get there in just a moment. Last class, we started our first chapter for this semester, Introduction to Managerial Accounting. So we reviewed a little bit about the contrast between financial and managerial accounting, who the intended audience is, what type of information might be included, prospective versus retrospective, using internal decision-making in managerial or management accounting. So the information is frequently proprietary, confidential. It can be packed together or put together in many different ways. We don't have that same overarching set of principles known as GAAP that you learned in financial accounting. So we have a lot more flexibility in what we're reporting. We talked about the flow of costs through the inventory accounts, including the idea of the 3 product component costs that go into every product that we make: direct materials, direct labor, and then those indirect costs that we tend to refer to as overhead. As I explained last week, the overhead part gets allocated. So it is more of a 2-step process. It doesn't go directly to the product in work in process, but instead they're accumulated in that overhead cost pool and then they get allocated. In Chapter 16, we will see one way, the traditional way, that those overhead costs get allocated to the product. But in future chapters, we'll look at other ways that that can happen as well. Where we're going to be starting today is on Exercise 7, which is an income statement for a manufacturing company. And so I wanted to remind you that the income statement for a manufacturing company looks very similar to that for a merchandising, or in this case, as it lists their retail business. Merchandising businesses can also be middlemen, wholesalers. But you can see that the income statements look pretty similar, except, as you would expect, retail businesses are buying their inventory, and so you see this net purchases calculation. And manufacturing businesses, of course, are making the product, so you see this cost of goods manufactured. Other than that, the income statements look basically the same. Now you'll notice manufacturing specifies finished goods inventory because, as we learned last week, unlike a merchandising company that has just one inventory account, a manufacturing company has at least 3. There are 3 different types, and those manufacturing companies are going to have at least one of each type. The types are materials, work in process, and finished goods. And I told you last week, finished goods is really analogous to that inventory account that we've been seeing since Chapter 6 in financial accounting. So that cost of goods manufactured serves the same role in this income statement for a manufacturing business as the net purchases does for a retail business. So an income statement for a retail business says, how much did we add to the inventory? Manufacturing businesses say the same thing, but it's a little bit more complicated because they have to calculate that cost of goods manufactured. And so we'll be getting to that today. In actually our very next exercise, we'll be looking at that cost of goods manufactured and what goes into that calculation. But for our first exercise, we're just going to be looking at the flow of cost that you see here to calculate that cost of goods sold. So in our first exercise, we're looking at this relationship. Beginning inventory plus what did we add to it? What did we make this period? Gives us what we had available for sale. And then if we subtract the ending inventory, we will know what we must have sold. again, just like for a merchandising business, the assumption is if we had it and we don't have it anymore, we must have sold it. We recognize that there might be some shrinkage for our manufacturing businesses, just like there was when we talked about merchandising businesses. Inventory shrinkage, remember, includes any product that is not available for sale. We had it, but it's no longer available for sale. It could have been stolen, it could have been given away, it could have been lost, it could have been damaged. And so there are many different reasons that our inventory might no longer be available for sale. And so the rule is, if we had it, we don't have it anymore, we count it as part of the cost of doing business. Now, that doesn't mean that we just accept it. Inventory shrinkage is always a concern, especially if we think it's missing as a result of some kind of fraud or theft. So I'm not suggesting that we just ignore it and pretend it didn't happen, but from the accounting standpoint, it still needs to be included in that cost of goods sold, because we had it, we don't have it anymore. It's part of the cost of doing business. Any questions about this, this structure for the calculation of the cost of goods sold? Okay. So let's go to our first exercise for today. Exercise 7. And you'll notice that the formatting looks very much like what I just was showing you on that income statement. We start with our beginning inventory. Well, how do we know what we had at the beginning of the month? Well, at the end of the month, last month, so in this case, May, at the end of May, we counted and assigned a value to it, or we estimated how much we had. So that beginning finished goods inventory is whatever we had at the end of last month. And hopefully, in an ideal world, we have confirmation of that. That is, somebody went around and counted it and said, okay, here's what we have, here's how much it's worth. We know that that physical inventory, actually counting and assigning a value to it, must occur at least once a year. And for some types of organizations, that may be the only time it happens on a global scale, that is, they're counting everything they have. But for other companies, they may do a physical inventory on a much more regular basis. So even think about a grocery store. If you've ever worked in a grocery store, you know, inventory happens maybe for the auditors once a year, but depending on the section of the grocery store, inventory might be happening on a much more frequent basis. So for example, think about a larger grocery store where you have a produce section. Well, that produce section is probably doing inventory maybe even once a week, because it's so changeable, because they are subject to inventory shrinkage, because things do spoil or get miscounted or mislabeled, or you know, the same kind of apples get like 3 different kinds of apples get taken out of inventory as just one kind. So now you're over in 1, you're over in 2, and under in 1, that kind of thing. It happens where the canned goods aisle might not get inventory more than, say, once a month or even once a quarter. So that physical inventory is key to verifying what we have. We're not spending time this semester really talking about perpetual versus periodic inventory systems, but just as a reminder, we did introduce that back in chapter 5 in financial accounting, for those of you who had me for that class. So companies that use a perpetual inventory system have a running total of what they believe they have on hand, and that physical inventory serves to confirm that, or lead to some hopefully minor adjustments to account for that inventory shrinkage. If you are a company that uses a periodic inventory system, the only way you know how much you have is to physically count it, take that physical inventory and assign a value to it, because you have not been keeping track on a regular basis. So for those companies that are few these days, those companies that use a periodic inventory system, it is much more likely that you're doing a physical inventory much more regularly, because you need to know what that ending inventory is, which, back to our exercise, becomes then the beginning inventory for the next month. In that chapter on inventories and financial accounting, we went through, so what happens if you make a mistake? What happens if you miscount? What happens if you overcount or undercount something? And we saw that if you start with the wrong inventory, but end with the correct inventory, between the 2 years that are affected, the totals will end up being correct. However, in order to provide as accurate and useful information as possible, we want to make sure that the inventory is as accurate as we can make it. And one way to ensure that is to do that physical inventory, at least as a confirmation of what we believe to be true based on our perpetual inventory system. So there's my review of some of the rules or requirements as far as inventory goes. So we start with that finished goods inventory. It's whatever we ended with last month becomes the beginning inventory. We add to that the cost of goods manufactured, and as I already indicated in exercise 8, we'll be looking at where does that number come from? How do we calculate that? Adding those two pieces together gives us cost of goods, finished goods available for sale. We go out and count our ending inventory or rely on our perpetual inventory system. And that's where we get the ending balance. And from there, we calculate the cost of goods sold, which is then subtracted from the revenues to get our gross margin or gross profit. In this exercise, you can see in each one of the 3 columns, there are 2 missing items. So it's just the way math works. If we have just one unknown, we can solve for that. So we're going to have to start with something that we know 2 pieces and we can calculate the third. So we couldn't jump right to B, for example, because we need to know A and the 130 to calculate B. So we can't calculate B right off the bat. We'll have to do A first. One of the reasons I just spent all these minutes going through where do these numbers come from and how do we know this is to just remind you that, as is not infrequently the case in this class, this is not a realistic scenario. There's no way that we would not know the beginning inventory and be able to calculate it based on what these other pieces. The whole point of this exercise is to make sure you understand how this works, what the mathematical relationship is between these various accounts or categories. It's not ever going to be the case that someone tells you, well, here's our cost of goods sold, here's our cost of goods available for sale and our manufactured, and what was our beginning inventory. That's not going to happen. But for our purposes, it does help us to reinforce the relationships here. So let's do this middle column together. The first column is really the easiest or most straightforward. So I'm going to leave that alone. Let's start with the middle column, and then we'll do the right-hand column and the left-hand column. So we'll start with the middle. We really could calculate either C or D independently, because each of those is a calculation where we're missing only one piece of the puzzle. So we'll start with C. Let me get my calculator open here. We'll start with C. So if we know that we have $540,000 worth of finished goods available for sale, and we only started with $38,880, how much must we have finished or manufactured this period? I was just looking at some data this morning that one of the areas where math students struggle consistently is the ability to estimate and do a reasonableness check. I'm going to do that here. I'm going to try to incorporate those kind of things, do my part for helping with the math area, even though this is clearly not a math class. I'm just gonna round off. If we have $540,000 worth of stuff available and we started with only about 40,000, it must be that we made about $500,000 worth, right? That's reasonable. That makes sense. So how did I do that? Well, I really subtracted. I started with the 540,000 and subtracted my rounding off or estimate of how much we had. When I plug in the actual numbers, I get $501,200 worth of product we must have manufactured this period. And I've already done my reasonableness check, and that's what I was expecting, something around 500, so I'm happy with that.
Oh, actually, I was doing this on
Okay.
my own,
Yeah,
and I got 501,120.
Yep, you are right, and that was just said here in the classroom as well, because I read the number wrong. I missed one of the 8. So 501,120. Thank you very much, Seth and Drew. So it says 38,880, and I read 38,8. So my reasonableness check with that helped to know I was in the ballpark, helped to know that I was subtracting when I needed to subtract rather than add. Let's go to letter D. If we had $540,000 worth of product available during the period, probably not all at one time. Let me just say that. This is accumulated over the whole month or quarter or year, whatever it is we're reporting on here. So we had $540,000 worth of merchandise available, and we ended with only 70,000. So JP posted in the chat, we must have sold 470,000. And again, we subtracted, right? We had 540 available. We ended with only 70. What happened to the rest of it? We must have sold it. Everybody good with these? Comfortable with the relationship between these pieces? Okay. So let's go ahead and do A on your own. And once you have A, you know you'll be able to calculate B, because now we have just one missing piece of that equation. I would encourage you to, if you're unsure, maybe even if you're not unsure, just say it out loud or in your head to make sure that it makes sense. Use those rounded numbers for the reasonableness check, if that helps you to see that, yes, that does make sense. We had about 120, we bought 825 more. We should have had about 940 something thousand available. That makes sense. And then if you have not already, go ahead and go over to do E and F as well. And once you're done with those, I would point out that you could do E or F first. We did not, unlike the first column, we did not need the answer to one of them to get the answer to the other. And once you have those two, use the check my work button. Make sure you have all green check marks. Got 10% for that exercise, and we'll be ready to move on. Does anyone have questions about any of that? All right, I will assume that then that everybody is good. And so we'll go back to the visuals. As I already mentioned, our next exercise is doing a statement of the cost of goods manufactured. In our previous exercise, we had that number as part of our income statement, as part of the calculation of cost of goods sold. But now we need to see review from last week, what makes a manufacturing business different than a merchandising business in terms of the calculation that goes into that. I reminded you last class that the statement of the cost of goods manufactured is not truly a financial statement in the sense that we used in financial accounting. The information that you see on this type of statement is proprietary. It is for internal use only. This is something that you would not necessarily want your customers, or sorry, your let me get the right word out, your competition to know what the split of your costs to make that product. This is not something that you are required to disclose, and you probably would not want this information out there publicly. So I would like to remind you, again, from financial accounting, some formatting tips. You'll notice that all of these dollar amounts have dollar signs in front of them. That's not because you would actually use a dollar sign there on the statement. It is to point out that those are dollar amounts, that they're just being generic or vague about. So from financial accounting, we talked about formatting issues. You'd have a dollar sign at the top of the column, here and here. After that, you don't need a dollar sign until you take a total. So if you see that this bar indicating that we're going to do some kind of a math operation, after that you'd have a dollar sign again. So we'd have a dollar sign here, but not here. We'd have a dollar sign here because it's the top one on the column, but not on the next two. No dollar sign here because this one is still carrying down. Dollar sign here because we've just done some math operation, not one here. And one other final formatting comment. The cost of goods manufactured, if this is the bottom line, if this is what you're calculating, you'd have the double accounting underline at the bottom of the column to indicate, okay, now we're done. That's the grand total or the final result. As we saw on, remember that hand-drawn flow chart that I told you is just a picture of my drawings on the whiteboard from a previous semester. What's being included on this cost of goods manufactured is really the ins and outs going through the work in process inventory account. So we start with the beginning work in process, which of course was the ending from the previous period. What did we add to it? Well, we add direct materials, direct labor, and overhead. We have to calculate how much we added for direct materials. And this little piece, these four numbers, are looking at the materials inventory, the ins and outs of that account. So the flows through that account. We add direct labor, the factory overhead that's allocated or assigned to the product. Adding those three pieces together tells us the total that was added to work in process during the month. If we add that to the beginning inventory, we know how much was in that account in total during the period. Then if we know how much is left in there at the end, we can back into this cost of goods manufactured. So in our next exercise, we're going to be looking at the flows in and out of the materials and work in process inventory account. And we'll go there next. I just want to remind you what I'm talking about here. In the chapter 15 folder, remember there are a number of resources in that reference materials folder for you, including a more involved statement of a cost of goods manufactured, such as we're about to prepare. A page that shows some basic calculations. And then this is what I was just referencing, the flows in and out of the materials and work in process inventory accounts. So you're really putting dollar amounts or values on all of these arrows coming in and out of these two accounts. So let's go do that. Any questions before we start exercise 8? Okay. So in exercise 8, we're going to be using the data that are provided there. We have beginning and ending inventories for materials, work in process, and finished goods. We're given some additional information about costs that were incurred during that month for direct labor, how much was purchased for the materials account, and then information about the factory overhead. So thinking about what we just saw in those examples, I want to start with the beginning inventory, the beginning work in process inventory. Now, I happen to have a printout of the exercise, so I'm probably not going to scroll up and down to see those, the information that was given. You certainly should do that as needed. But it's easier for me if I just, whoops, not do that. If I just leave it here where you're going to be able to see most of the exercise without the up and down. So what was our beginning work in process? It's given at the top of the page, $435,900. Again, you'll notice the dollar sign there. Just as I was just describing, you can see that they have the dollar signs here correctly positioned at the top of each column, and then only when we take a subtotal or a total. And then again, you've got the double accounting underlined down here at the bottom as it should be. So now in this next section, we're going to be analyzing the flow of costs through the materials inventory account. We start with the beginning balance as of March 1st. What did we add to that to know what we had available for use? If we then subtract our ending inventory, we will know how much we actually used. So it's that same analysis of the flows in and out of that materials account. Beginning, what did we add to it? That's what we had available. What did we have left at the end of the month? Whatever's missing, we assume was used. There was a request issued for it. It was moved using the terminology we talked about last week. Someone came to the warehouse and grabbed those materials and took them out to the shop floor. So we, in our accounting records, moved them out of materials into work in process. So now we can go about filling in the blanks here, now that we know what the basic format is going to be. And remember that these calculations, this format is on that basic calculations page that I just showed you in Blackboard. I just reminded you where it was. And so the materials inventory at the beginning of the month was $210,000. We are told that the purchases during the month were $2,666,200. So we add that to the beginning balance. We get $2,876,200. Now during the month, in particular, if we're not using a perpetual inventory system, we just keep using materials, and maybe not keeping track of it every time we have a request. And so at the end of the month, we go around and say, okay, well, how much do we have left out here in the warehouse? And assign a value to that. And the ending materials balance was $193,100. And so now from there, we take what was available, we subtract what we had left, and the difference must be what we used.
I have a question, Cindy. Okay, you, to get that cost of direct materials used,
Mhm.
you just take the last two bottom ones, right? And subtract those
Yep.
to get the cost of direct materials.
Yep, so we added those two to get the 2,876,000, and then here we subtracted the ending inventory to get the direct materials used.
Okay,
Yeah.
thank you.
Yeah, and yeah, I'm glad you asked, Jamie. And just as a reminder, if I go back here. So this is the page I was just mentioning, the basic calculations, and it's right here. So that same calculation we just did is right here with the pluses and minuses in the necessary spot. So if you get stuck, if you're not sure, come back here and refer to this page. What we're going to be doing next is this calculation. And so again, you can see the pluses and the minuses in the appropriate spots. So always come back and refer to this if you're really not sure.
And that's under chapter, or that's in chapter 15 references, or
Yes,
just, okay,
chapter 15.
thank
Yep.
you.
Okay. So we're looking at, now we're back to the work in process inventory. So we know what came out. If I were to go back to that flow chart here. So we now know what we started with in work in process. We now know what we added to it here, the direct materials requests. Next, we're going to add this direct labor piece and the overhead allocation. So direct labor. How much did we add in direct labor? And it's given right in the top number in that list of information in the exercise. Direct labor was 3,500,000. The last piece we need to add, new costs incurred, are the factory overhead. And for this exercise, they've given us a list. So you can just go down that list of factory overhead incurred during March and add those. Taxes, and the last one is miscellaneous. So we're just going to go down the list and add those pieces. Now, I would mention that it appears here as if they're adding those directly to work in process. That's not how it happens. Unless this is the only product they make, they would start with all of those costs in a manufacturing overhead account, and they would allocate them in a lump sum. So this is a little bit misleading in the way this is written. I think they do that because at this point, we're just learning about indirect costs like factory overhead, and they want to be reminding you what types of costs would be included there. Oops. So you'll notice. Oh, thank you, JP. Save me using my ridiculous calculator. And yes, for those of you who were with me last semester, I am still fighting the calculator issue, and I'm using my ridiculous, not very helpful cell phone calculator. I'm still trying to decide if I actually want to cave in and use a different calculator. But for now, I'm using this calculator that's just not terribly helpful because it's too slow. It doesn't let me punch more than one button in a time frame. So what we have now is the 3 product component costs that we learned last class. We have direct materials, we have direct labor, and we have the overhead costs. Those are all of the costs for the product that we worked on this month that were added to that account. And so the next line, total manufactured costs incurred during March, is going to be the total of those 3 pieces. The direct materials, direct labor, and overhead. And if we take that amount and add it to what we had at the beginning of the period, did I add those correct? I didn't add those correct. See?
I got 6,998,700.
Thank you. Is that what others got? Yeah. As soon as I looked at did my reasonableness check.
I was like, what did I do wrong?
3,800,000 is not 4 million. So, yeah, no.
I was like, okay, I misunderstood.
No, totally. I'm gonna continue to blame this ridiculous calculator.
Where do the total manufacturing costs come from, that number?
It's the total of the direct materials, which is here, the direct labor, which is here, and then the overhead. So it's all the costs we added during this month. So it should be the sum of those 3 numbers, that, and that. Everybody good so far? So now we know what was added during the month, and up here at the very top, the first number we entered is what was already in there. So if we take what was already in that account, 435,900, and the about 7 million that we added to it, we will have the total manufacturing cost that went through that account in the month of March. What did we start with? So that's stuff that we started working on in February but hadn't finished. And then all the costs associated with the work that we did in the month of March. We had about $7.5 million worth of stuff go through the work in process inventory account during the month of March. But just like in February, it's likely that at the end of March, there's some stuff that we still haven't finished. And so we want to know, how much did we not have finished at the end of March? What was the ending balance in the work in process inventory account at the end of March? And that was given in the exercise. 510,400. And so from there, if we were working on about $7.5 million and there's about $0.5 million left, then we must have finished about 7 million. To find the exact number, we're going to subtract. Total manufacturing costs minus the ending inventory and work in process tells us how much stuff did we finish this month. That number, as we already saw in the previous exercise, that number is needed for our income statement. All of the detail that went into that is kind of hidden, if you want to think of it like that. It's internal. So internal people have access to those data, but it's not on your financial statements that you share publicly. Not a requirement that we tell people what makes up that cost of goods manufactured. And so we probably want to keep that to ourselves. Any questions up to this point? Okay, so I want to go back to that formula sheet to do the next part, because what we're going to be doing Maybe I'll make this a little bigger. Whoops, not smaller, bigger. Yeah. So here's what we're going to be doing for the very last question. So I'm going to use this formula. Beginning finished goods plus what did we add to it to know what we had available for sale. Then we subtract the ending finished goods to find our cost of goods sold. And I'm going to do the calculation right here on this screen, and then I'll go back and put it in on Cengage. So our beginning finished goods inventory was given to us. $586,200. That's how much stuff we had available at the beginning of the month, already completed. The cost of goods manufactured is what we just calculated. $6,924,200. Trying to get them to line up pretty. We need to add those two together to know what we had available in total. And then, so we know we had about $7.5 million worth of product available for sale, but we're probably not lucky enough to have sold all of it. And if we look back at the information that was given, there was, at the end of the month, $615,900 worth of stuff still left, unsold. Not suggesting that's really a bad thing, because now we have some product to sell at the beginning of next month. But ideally, we don't have a whole lot of inventory sitting around unsold at any given time. And so if I just did that math right, 6,894,500, it should be our cost of goods sold. So again, all I was doing was using the formula that's here in the reference materials for chapter 15 in Blackboard, plugging in what we know to allow us to calculate what we don't know. The missing piece, cost of goods sold, 6,894,500. And so coming back over to Cengage, I'm just going to plug that number in. We know where it came from. You can see how we use those formulas in Blackboard. Ideally, you'll be able to remember those formulas, be able to understand the relationship between the arrows, the amounts moving in and out of those accounts. But until you're confident that you understand that and get that, just refer back to those formulas anytime you need to. And I'm going to hit the check my work button and make sure we have all green check marks and that we got 10% for that assignment. We got the green check mark over here showing that we're done. We're good. Questions on that exercise before we move on? Okay. And we will keep going. Exercise 9 is an additional review of what we have just done. So we're expanding this a little bit. We calculate our cost of goods sold just as we did on the last exercise. Calculate our gross profit, which is always going to be sales or revenues minus cost of goods sold. And then we're going to plug that part into our net income calculation. So we start with our gross profit that we just calculated in B. We subtract our operating expenses, which are selling, general, and administrative expenses, to get our net income. So with this in mind, I'm going to ask you to complete this exercise on your own, just to make sure that these concepts are making sense to you. I'm going to pause the recording. And so if you're watching on the recording, try this exercise on your own. Once you have it, you can use the check my work button to make sure that you've got it. If you can't get it, just restart the recording, because we'll briefly go through it once everyone's had a chance to finish. I'm going to pause the recording now. So looking at exercise 9 then, putting in those same relationships that we saw in the previous exercises. We calculated our cost of goods sold as what did we have available, what did we add to it? That's what we had available for sale during the whole period. How much did we have left at the end of the month? Subtract to get cost of goods sold. Now, I should point out that Cengage frequently, if you need to subtract something, you can put in the minus sign if that helps you remember. And most of the time it will count that number right, whether you put in the minus sign or not. Occasionally though, it will say in the instructions, use minuses to show subtraction or something like that. So occasionally it will mark it wrong if you don't put the minus sign. But I believe that every time it requires that you use the minus sign, it tells you you have to use them. So for people who haven't used Cengage before this semester, that's something to keep in mind. Normally it will mark it correct as long as you have the right numbers, whether you use the negative or not. Moving on then to gross profit, our sales were given. We just calculated cost of goods sold in part A. So we're just carrying that number down and subtracting to get our gross profit. So again, I could put the negative sign in there if that helps me to remember. And finally, we have that gross profit. So we can, from that, calculate our net income by subtracting the operating expenses, selling and administrative expenses. The total is here. Again, I probably could put a negative sign in there and subtract from gross profit to get our net income. Yep, and so you can see it marks it correct, green check mark, whether you use the minus sign or not. Occasionally, though, it will tell you you have to use those minus signs and it will mark it wrong. Even if you've subtracted, it will mark it wrong if it tells you to use the minus signs and you don't. You know, that can be a frustration when you're used to exercises like this where you can put it in or not put it in. But please make sure you read the directions carefully to avoid thinking you've done something incorrectly when it's really correct, except you didn't follow the directions. Before we move on to our final exercise for this chapter, any questions? Let's move on then. So this exercise again is to just make sure that we're reinforcing these cost flow relationships through the inventory accounts on the balance sheet and then by cost of goods sold over to the income statement. I think these are going to be fairly straightforward, simple single step calculations to get each one of these as long as we go through it step by step. So let's try that. So what is our cost of goods sold? Now, if we haven't seen this yet, again, if you haven't used See Now before, you might be still learning some of the features. I will point out for this exercise, so you won't need it because we're doing it in class together, but frequently the exercises do have this Show Me How button that gives you a little bit, maybe a lot, more assistance than just using the Check My Work button. In general, I would encourage you to try it on your own first when you're doing exercises or working on the homework problems outside of class before you use the Show Me How. If you see the green words, if you hover over that, you can see that it's going to pop up some additional information. Usually it is a description or a definition of that term. So cost of goods sold, we already know that cost of goods sold is the cost of goods manufactured. Now you'll notice it does say that this is the first month of operation, so they've made it a little simpler for us. We don't have any beginning balances. So that's one way that they have simplified these calculations. So if there weren't any beginning balance, then the cost of goods sold would need to be what we made in our first month, $396,000 worth of product, and what we had left. Oh, so I'm trying to make this harder than it really is. So there we go. So this is, again, one of those exercises where we're doing things a little bit out of order. So I was trying to do things from start to finish, saying cost of goods sold would be what we had available. That's the cost of goods manufactured minus what we had left. But we're not given that information, so I've got to go about this from a different direction. Cost of goods sold is also sales minus gross profit. If we go back to this, no, I don't have it there. So if we, this is the concept all the way actually back from chapter 4 in financial accounting on the multi-step income statement. Sales minus cost of goods sold equals gross profit or gross margin. So since we know those two pieces, we can figure out that missing part. So 792,000 minus 462,000, our cost of goods sold would need then to be $330,000. So this exercise is making us think about this a little bit. I don't like the expression think outside the box, but it really does require us to think about things in a little bit different order than what actually happens to make sure that we understand how all of this fits together. So now the next question is, what did we have left at the end of the month? Well, we know we made $396,000 worth of product this month, and how much did we sell? $330,000. And so how much must we have left? Of the $396,000 we sold $330,000. We must have $66,000 left. The next question asks for our direct materials cost. And so we're looking for information about materials. Well, we know we purchased $244,200. We didn't have a beginning balance because this was our first month of operations. So we bought $244,200 worth, and at the end of the month, we had $33,000 left. So how much must we have used? Of the $244,200 we purchased, we had $33,000 left. How much did we use?
Is it $211,200 or
It
200?
is.
I mean,
That is exactly it, $211,200. It's the 244,200 that we bought, that we purchased, minus the 33,000 that we had left. We used all of the rest of it. Well, now we're asked about direct labor, and I don't see any information here about direct labor. I see information about indirect labor. But what do we know? Well, we know the total manufacturing costs for the period. And if we think back to exercise 8, what went into that total manufacturing cost? Well, it's the 3 product component costs that we already know: direct materials, direct labor, and overhead. make up those total manufacturing costs. So if we know the total, let me get my annotate up here. If we know the total and then we subtract from that the direct materials that we just calculated, and if we can subtract our overhead costs, then whatever's left must be the direct labor. So what do they tell us here for the overhead costs? I see indirect labor and factory depreciation. Those are the only two things I see listed there that are indirect costs. So I'm going to assume that those are our only indirect costs. Those are our only overhead costs. Because I have to believe, I have to hope that they're giving us all the information we need to do this exercise. So we know that in those total manufacturing costs, it includes direct materials, direct labor, and overhead. If we can subtract the direct materials and the overhead, what's left must be the direct labor. Does that make sense? And I got 46,200 for that. Everybody's good? Last question for the chapter. One chapter down and 13 to go. Work in process inventory at the end of the month. Well, we know there wasn't a beginning balance. We know what we added to it. That's this, the total manufacturing costs. And we know what we completed and moved out. And if you look back at that flow chart in the reference materials folder, at that work in process inventory account, we added to it 455,400. We took from it 396,000 because that's no longer in process. It's now finished. It's in finished goods or it was sold. And so if we just subtract the total manufacturing costs minus the cost of goods manufactured, that's the part that was completed, what's left must be the ending balance in work in process. I'm gonna hit the check my work button. We like to see those green check marks. No, I didn't have a math error in there anywhere. Any questions as we finish up chapter 15? Okay, as I said, because we do have a significant portion of time left for class, I'm going to stop this video. We are done with chapter 15.
I'm sorry, can we review this part?